Accounting records business transactions and communicates the result in the form of final accounts. To ensure that everyone comprehends the accounting results in the same manner, certain accounting assumptions, concepts, and principles have been developed. There are 4 basic assumptions of accounting. They are business entity assumption, money measurement assumption, accounting period assumption, going concern assumption. We will look into each of them briefly. Business entity assumption treats the business as a separate entity from its owners. That is, the transactions and balances of a business entity are to be accounted for separately from its owners. Any personal expenses incurred by the owners will not appear in the income statement of the business. This is why even the proprietor is treated as a creditor to the business. In short, keep business transactions separate from personal transactions. Money measurement assumption or measurability concept means that only transactions that are capable of being measured in monetary terms are recorded and recognized in the financial statements. For example, any internal conflict between departments can affect business, but they are not recorded as it cannot be measured in terms of money. In short, measure only those that can be quantified in terms of money. As per the accounting period assumption, the users of financial statements need periodical reports to know the operational result and the financial position of the business concern. Hence, it becomes necessary to close the accounts at regular intervals. Usually, a period of 365 days or 52 weeks or 1 year is considered as the accounting period. Going concern assumptions in accounting is the basis of which financial statements are prepared. Financial statements are prepared assuming that a business entity will continue to operate in the foreseeable future without the need or intention on part of the management to liquidate the entity or to significantly curtail its operational activities. Therefore, it is assumed that the entity will realize its assets and settle its obligations in the normal course of business. It is the responsibility of the company management to determine whether the going concern assumption is appropriate in the preparation of financial statements. If the going concern assumption is considered to be invalid, then while preparing the financial reports, the assets will be recognized at the amount which is expected to be realized from its sale rather than from its continuing use in the ordinary course of the business. Assets are valued for their individual worth rather than their value as a combined unit. Liabilities shall be recognized at amounts that are likely to be settled.